Hello everyone, welcome to the 130th episode of me learning how to trade in Forex. So in the last episode, we finished off the Baby Pips School Pipsology course, all of it. So we went through the last lesson, which was love the Forex game. Hardworking and loving what you do is important for success. There'll be days when trading sucks, but if you embrace the challenge of trading currency markets and have fun picking it apart, your chances of surviving and thriving will be improved immensely. And also, never quit improving every day. So after that, I think what happened was, let me just scroll up. I went through the top tabs and saw that there was still this website opened up. IG, what is Forex and how does it work? First course that I've read, well, one of the first two courses I've read since I first started learning how to trade Forex. So I was reading through what the notes I've made, but then I realised that I haven't actually properly finished making all the notes. I forgot the reason why I finished making the notes, to be honest. I think it's either because I didn't really understand what I was writing, or I don't know, I just didn't get time to finish it, whatever. But yeah, now we're gonna finish off making the notes for this page today, and then we're gonna start doing the online trading courses that IG has to offer. So yeah, let's get started then. So what is Forex and how does it work? What is Forex trading? Forex trading, also known as foreign exchange or FX trading, is the conversion of one currency into another. FX is one of the most actively traded markets in the world, with individuals, companies and banks carrying out around $6.6 trillion worth of Forex transactions every single day. So what is that? A conversion of one currency to another. Let's put Forex trading is a conversion of one currency to another. Yep. While a lot of foreign exchange is done for practical purposes, the vast majority of currency conversion is undertaken by Forex traders to earn a profit. The amount of currency converted every day can make price movements of some currencies extremely volatile, which is something to be aware of before you start Forex trading. Yep. Okay, I think we'll be watching that video because we watched it before. We're the UK's #1 retail Forex provider with a range of major, minor, and exotic currency pairs for you to go long or short on. Yep, Beginner's Guide to Forex, learn currency trading in 6 steps. Forex trading essentials for beginners. So what is a Forex pair? A Forex pair is a combination of two currencies that are traded against each other. There are hundreds of different combinations to choose from, but some of the most popular include the Euro against the US dollar, Euro USD, the US dollar against the Japanese yen, USD JPY, and the British pound against the US dollar, GBP/USD. So a Forex pair is a combination of two currencies that trade against each other. Yep. Cool, that's good. What are the base and quote currencies? The base currency is always on the left of the currency pair, and the quote is always on the right. The base currency is always equal to 1, and the quote currency is equal to the current quote price of the pair, which shows how many of the quote currency it will cost to buy one of the base. So when you're trading currency, you're always selling one to buy another. So what I've written here, base currency on the left, quote currency on the right. Yep. Base currency always equal to 1, quote currency is equal to the current quote price of the pair, shows how many of the quote currency is needed to buy one base currency. Yeah, that's good. Pairs, so base currency, yep, that's pretty good. What is a pip in Forex? A pip in Forex is usually a 1-digit movement in the 4th decimal place of a currency pair. Pip is a 1-digit movement in the 4th decimal place of a currency pair. Yep, so 1 pip. So if GBP USD moves from 1.36 or 1.35361 to 1.35371, then it has moved a single pip. Because looking at the 4th digit, so 1, 2, 3, 4, 1, 2, 3, 4, 6 plus 1 is 7. But if you're trading JPY crosses, a pip is a change at the 2nd decimal place. A price movement at the 5th decimal place in Forex trading is known as a pipette. So that's a pip because that's a fourth decimal place. But with trading JPY crosses, a pip is a change at the second decimal place. A price movement at the fifth decimal place is a pipette. Very good. What is a lot in Forex trading? Currencies are traded in lots, which are batches of currency used to standardize Forex trades. As Forex price movements are usually small, lots tend to be very large. For example, standard lot is 100,000 units of the base currency. Currencies are traded in lots, which are batches of currency used to standardize Forex trades. As Forex price movements are usually small, lots tend to be very large. For example, standard lot is 100,000 units of the base currency. Currencies are traded in lots, which are batches of currency used to standardize Forex trades. Standard lot is 100,000 times by whatever the base currency is. Okay, makes sense. How does Forex trading work? Forex trading works like any other transaction where you are buying one asset using one currency. In the case of Forex, the market price tells the trader how much of one currency is required to purchase another. For example, the currency market price of the GBP-USD currency pair shows how many US dollars it would take to buy £1. Each currency has its own code, which lets traders quickly identify it as part of a pair. We've included codes for some of the most popular currencies below. Okay, yep. CAD, so 3-letter ISO codes. Yep, very good. What does it mean to buy or sell a currency pair? So, to buy a currency pair means that you expect the price to rise, indicating that the base currency is strengthening relative to the quote currency. To sell a currency pair means that you expect the price to fall, which would happen if the base currency weakened against the quote. For example, you'd buy the GBP-USD pair if you think that the pound will strengthen against the dollar, meaning you need more dollars to buy a single pound, or you sell this pair if you think the pound will weaken against the dollar, meaning you need fewer dollars to buy a single pound. Have I not written this down? Market price rise above the below. So that bit there. To make a profit, you'll need the market price to either rise above the buy price or lower below the sell price. Or drop below the sell price. I guess I didn't write this down. So to buy a currency pair means that you expect the price to rise which indicates that the base currency is strengthening against the quotes currency against the quote currency. To sell a currency pair means that you expect the price to drop, which indicates that the base currency is weakening against the quote currency. Yep, so for example, you buy the GBP USD pair if you think the pound will strengthen against the dollar, meaning you will need more dollars to buy a single pound, or you'd sell this pair if you think the pound will weaken against the dollar, meaning you need fewer dollars to buy a single pound. What is spread in Forex trading? The spread in Forex trading is the difference between the buy and sell prices. For example, the buy price might be 1.3428 and the sell price might be 1.3424. For your position to be profitable, you'll need the market price to either rise above the buy price or fall below the sell price. Here's the profitable bit, depending on whether you're going long or short. So, the spread in Forex trading is the difference between the buy and sell price. You need the market price going rise above the buy price, or depending on where you're going long or short. Yep. You need the right. Okay. What are margins and leverage in FX trading? Margins refer to the initial deposit you need to commit in order to open and maintain a leveraged position. So a trade on Euro GBP might only require 3.3% margin or 3.33% margin in order for it to be open. As a result, instead of needing £100,000 open position, you only need to deposit 3,300. Margin, i.e. a trader might require 3 in order for it to open. As a result, instead of needing... But remember guys, as a beginner trader, don't rely on the margin. Leverage, sorry. Use as little leverage as possible. It's even better if you use no leverage at all. You know, that's good. What is it? Why do people trade Forex? Wait a second. Yeah, okay. Why do people trade Forex? Speculating on currency strengthening or weakening. So, what have I done? Traders speculate on Forex pairs to profit from one currency strengthening or weakening against another. When the price means that when the price of a pair is rising, it means the base is strengthening against the quote, and when it's falling, the base is weakening against the quote. That's because a rising price means that more of the quote are needed to buy a single unit of the base, and a falling price means that fewer of the quote are needed to buy a single one of the base. So traders are likely to go long if the base is strengthening relative to the quote currency, or short if the base is weakening. So, when the price of the pair is rising... this means the base currency is strengthening against the quote currency, i.e. more of the quote currencies need to buy the same amount of base currency. Yep. When the price of the pair is falling, this means the base currency is weakening against the quote currency, i.e. less of the quote currency is needed to buy the same amount of the base currency. Makes sense. Some of the most popular Forex trading styles are scalping, day trading, swing trading, position trading. You might choose a different style depending on whether you have a short or long-term outlook. So these are the different currency trading styles. So let's just write popular Forex trading styles are shown below. So got scalping, positions are open and close quickly with the aim of taking small profits. Day trading, position open and close within a day. Swing trading, traders look for highs and lows, then trades in anticipation of a price reversal. Trend trading, positions are opened in line with overall trend. Position trading, positions are held for a long time, weeks, months, or even years. We've got the short term on the left and then long term on the right. Hedging with Forex. Hedging is a way to mitigate your exposure to risk. It's achieved by opening positions that will stand to profit if some of your other positions decline in value, with the gains hopefully offsetting at least a portion of the losses. Currency correlations are effective ways to hedge Forex exposure. An example would be Euro USD and GBP USD, which are positively correlated because they tend to move in the same direction. So you could go short on GBP USD if you had a long Euro USD position to hedge against potential market declines. You know what? This currency correlation, right? Didn't we read in babypips.com that it's kinda useless to do this? So if both currency pairs are like positively correlated, you go long on one position, on one currency pair, and then you go short on the other currency pair. Even if you do make a profit on the on one of the pairs, and you make a loss on the other one, the loss would pretty much eat up all your profits in one of the currency pairs. So you either be left with like barely any profit, or you'd be left with barely any loss. Oh wait, you'd be left with a loss because the pair could go in the opposite direction that you wanted to. So it could drop instead of rise, which means one of your trades would be right. Or basically, whoever has the largest position is gonna determine the profit or loss. So if the loss position was larger, then you're gonna end up with an overall loss, and if the winning position was larger, then you're gonna end up with a profit. That's what I wanted to say. I don't know why that took me so long to say it, but yeah. I think what they said do make sense, but it might be a bit pointless though, because you're just going to be eating up some of your profit basically. But then again, you could mitigate some of the risks that are involved in that position if you go the other way, and then it cancels the losses out. So it still works, I guess. So hedging is a way to mitigate exposure to risk of losing money. Nice grammar, me. This is done by opening positions that will stand to profit if some of your other positions decline in value, with the gains hopefully be able to offset at least a portion of the losses. Currency correlations are effective ways to hedge Forex exposure. Seizing opportunity 24 hours a day. The Forex market is open 24 hours a day thanks to the global network of banks and market makers that are constantly exchanging money. The main sessions are the US, Europe, and Asia, and it's the time differences between these locations that enables the Forex markets to be open 24 hours a day. So, okay, nice explanation for the diagram, me. The Forex market is open 24 hours a day. Is it 5 days a week? The Forex trading hours, market hours, are incredibly attractive, offering you the ability to seize opportunity around the clock. We are also the only provider to offer weekend trading on certain currency pairs, including the weekend GBP USD, Euro USD, and USD JPY. That means you can trade these combinations when others can't. Fair enough. Learn how currency markets work. What moves the Forex market? The Forex market is made up of currencies from all over the world, which can make exchange rate predictions difficult, as there are many forces that contribute to price movements. That said, the following factors can all have an effect on the Forex market. So, factors which move the Forex market include supply and demand. So, supply and demand. Exchange rates for Forex pairs are based on the supply and demand of one currency versus another. In basic terms, if the demand for one currency is greater than the other, then the price of the first currency will rise against the second. The below factors all feed into what influences supply and demand. Because the currency trade, if one currency is in a higher demand than the other, then the price of the first currency is going to be more than the second currency. Yep. Central banks. A currency supply is controlled by central banks, who can announce measures that will have a significant effect on the currency's price. Central banks choose whether to increase or decrease interest rates. Typically, when a country chooses to raise interest rates, the country's currency may increase in value. This is because it attracts foreign investors who want to benefit from the high interest rates. Quantitative easing, meanwhile, involves injecting more money into the economy and can cause the currency's price to fall in line with an increased supply. So, a currency supply is controlled by the central banks. Central banks can decide to increase or decrease interest rates. If the interest rate rises, the country's currency value may also increase. This is because more foreign investors will be interested due to higher interest rates. Yep, quantitative easing involves injecting more money into the economy, therefore increasing the supply, which causes the currency's price to fall. Yep. One of the interest rates and carry trades. One of the more popular investments among institutional investors is called a carry trade, based on interest rate differentials between countries. This involves selling a currency with a low interest rate with the goal of using the proceeds to buy a currency with a high interest rate. This aims to capture the difference between the rates. Carry trade is based on the interest differentials between countries. This involves selling a currency with a low interest rate and using it to buy a currency with a high interest rate. Fiscal policy. This is how governments influence the levels of and allocations of taxes and public spending. The currency of a country, for example, with a high debt ratio and lower growth is likely to be sold off. FX traders may instead prefer to buy a currency of a country with lower debt and higher growth. Fiscal policy is how government influences the levels and allocations of taxes and public spending. A currency of a country with higher debt ratio and low growth is likely to be sold off. For a currency with low debt ratio and high growth. International trade. Both anticipated and actual international trade between countries also influence FX prices. For example, a currency from a country with a trade deficit could be worth less than one with a trade surplus. I'm going to read that again. A currency from a country with a trade deficit could be worth less than one with a trade surplus. This is because a country with a trade deficit imports more goods than services than it exports, and therefore needs to buy the currencies of its trading partners to pay for those exports. So therefore, increase demand, which increases the value of the other country's currency. So a currency from a country with a trade deficit could be worth less than a country with a trade surplus. A trade deficit country imports more goods and services than exports, therefore they will need to buy the currency of its trading partners to pay for those imports. News reports and market sentiments. Commercial banks and other investors tend to want to put their capital into economies that have a strong outlook. So if a positive piece of news hits the markets about a certain region, it will encourage investment and increase demand for that region's currency. If negative news hits, then demand might be expected to fall. This is why currencies tend to reflect the reported economic health of the region they represent. So, economies with a strong outlook are attractive for investors. If a piece of positive news hits the market regarding a certain region, then it will encourage investments and increase demand for that region's currency. If it's negative news, then the demand might fall. This is why currencies tend to reflect the economic health of the region they represent. Good. Market sentiment, which often reacts to the news, can also play a major role in driving currency prices. If traders believe that a currency is headed in a certain direction, they will trade accordingly and may convince others to follow suit, increasing or decreasing demand. Market sentiment is how one trader might convince other traders to follow due to various news which might increase or decrease demand. to follow the trade direction due to various news which might increase or decrease demand. Due to their reaction to the news which might increase or decrease demand. So how to become a Forex trader? Learn the ways to trade Forex. There are several ways to trade Forex, including trading spot Forex, Forex forwards and currency options. When you trade with us, you'll be speculating on the price of spot Forex, forwards and options, either rising or falling with a spread betting or CFD account. CFD being contract for differences. Spot Forex trading lets you trade Forex pairs at their current market price with no fixed expiries. So I think that's normal Forex trading basically. Forex or currency forwards enables you to trade Forex pairs at a specified price to be settled at a set date in the future or within a range of future dates. Forex or currency options lets you trade contracts that give the holder the right but not the obligation to buy or sell a currency pair at a set price if it moves beyond that price within a set time frame. So, there are several ways to trade Forex, including spot Forex trading, Forex forwards, and Forex options. So, spot Forex lets you trade Forex pairs at their current market price with no fixed expiries. So you trade Forex pairs at their market price with no at their current market price with no expiries, no fixed expiries, that is not how you spell expiries, is it? Expiries. Forex or currency forwards enables you to trade Forex pairs at a specific price to be settled on a set date in the future or within a range of future dates. So you trade Forex pairs at a specified price to be settled at a set date in the future or within a range of future dates. Forex options lets you trade contracts that give the holder the rights but not the obligation to buy or sell a currency price at a set price, a currency pair at a set price. You trade contracts that give the holder the right but not the obligation to buy or sell a currency pair at a set price if it moves beyond that price within a set time frame. Time frame, not time price. All these spot forwards and options can be traded with FX spread bets and FX CFDs. These are financial derivatives which let you speculate on whether prices will rise or fall without having to own the underlying assets. Okay, what is a Forex broker? A Forex broker provides access to trading platforms that can be used to buy and sell currencies, which I think what I wrote here. And right ended for some reason. For example, when you trade Forex with us, you'll be able to use our award-winning platform or MT4, both of which have their own unique benefits. MetaTrader 4. Forex brokers charge a fee, usually in form of a spread. Brokers usually charge a fee in the form of a spread. This is the difference between the buy and sell prices. Spread is the difference between the buy and sell prices, which are wrapped around the underlying market price. The cost for a trade are factored into these two prices, so you always buy slightly higher than the market price and sell slightly below it. Traditionally, a Forex broker would buy and sell currencies on behalf of their clients or retail traders, but with the rise of online trading, you can buy and sell currencies yourself with financial derivatives like spread bets and CFDs, so long as you have access to a trading platform. This is because all Forex trades are conducted over the counter rather than on exchange like stocks. Discover the risks and reward of trading Forex. Forex is the most traded financial market in the world, which means that Forex prices are constantly moving, creating more opportunities to trade. Some Forex pairs are more volatile than others. Those with low liquidity are often more volatile, including many minor pairs. So, currency pairs with low liquidity are often more volatile. Pairs that include USD are often more liquid because of the world's reserve currency. USD is often in high demand. Pairs that include USD are often more liquid. Slippage is sometimes an issue in Forex trading, given how volatile the market can be. To help mitigate effects of slippage on your Forex trades, you should add stops and limits. Add stops and limits to mitigate the effect of slippage in Forex trading. Remember, slippage is like the process of the price slipping. So if you want to buy at a specific price, but then I don't know, the broker's not fast enough to react to it or something, or the market's just moving too quick, then by the time you place your order and by the time you actually, well, the Forex broker's actually notified you that they received the order, the price, there's going to be like a price difference, and that price difference is the slippage. Yeah. So for example, you place your order at 1.36, but then the order actually gets executed at 1.37. That's a slippage right there. But if you're aware of the risks and take appropriate steps to mitigate your exposure, then the Forex market can be the source of your next opportunity. Free Forex trading courses and webinars. To succeed when trading Forex, you need to take advantage of educational resources and platforms to help you build your confidence. We offer both IG Academy and our demo accounts. IG Academy has a wealth of information to get you acquainted with the markets and learn the skills needed for boosting your chances of trading Forex successfully. Alternatively, you can use an IG demo account to build your trading confidence in a risk-free environment, complete with £10,000 in virtual funds to plan, place and monitor your trades. We also offer trade strategy and news articles for all experience levels. This includes novice, like how to be a successful day trader, up to expert, looking at technical indicators that you've perhaps never heard of. Once you've built your confidence and feel like you're ready to trade live Forex markets, you can create a live account with us in 5 minutes or less. You'll get access to award-winning platforms, expert support around the clock, and spreads from just 0.6 points. 0.6 points? Okay. So, IG Forex trading tips for beginners. Determine your risk for per trade. Was it? Forex trading tips for beginners. Determine your risk per trade. The risk per trade method is a basic money management strategy in trading. It involves deciding how much of your trading account you're willing to risk on any single trade. In general, it's best not to risk more than 2 to 3% of your account on the trade. This ensures you have enough money to handle a series of losses. It's better to risk small amounts and gradually increase your account rather than risk too much and deplete your trading funds. See, this is like, remember in the Baby Pips School of Pipsology, when deciding how much you should risk, although they said that there's deciding how much you want to risk per percentage of your accounts, they don't necessarily recommend it because it depends on the market conditions and whatever. Like sometimes, I don't know, what does they say? I forgot what to say. I should risk. Risk management. Okay, never mind. I can't find it, but it's somewhere. It's somewhere. I remember. I definitely remember because I've written stuff about it. So I'll know once I've started reorganizing everything. Anyway, so yeah. Decide on how much of your account you're willing to lose per trade. In general, it's best not to risk more than 2 to 3% of your account on a trade. This ensures you have enough money to handle serious losses. It's better to risk small amounts and gradually increase your account rather than risk too much and deplete your trading funds. True. Don't overtrade. There's no need to make a trade every hour, every other day, or even every day. Wait for a good trade setup and avoid chasing the markets for trading opportunities. Patience and discipline are key to successful trading. Oh hey, these two key words, patience and discipline. Overtrading won't help even with the best money management plan. No need to chase the market for trading opportunities. Wait. Be patient and have discipline to wait for a good trade setup. Cut your losses and let your profits run. Successful traders follow the rule of cutting losses quickly and letting profits run. They close losing positions early, but let winning positions continue. Beginners often do the opposite, holding on to losing positions hoping they'll turn around, and closing profitable positions too early for fear of missing out on it. It's important to adopt the mindset of cutting losses and maximizing profits. Close losing positions early, but let winning positions continue. Always use stop loss orders. Stop loss orders are vital for risk and money management and should be part of any trading money management plan. A stop loss order automatically closes your position when the price reaches a certain level, limiting potential losses. All trading money management strategies should include stop loss orders. This should be included in every trade. Automatically closes your position when the price reaches a certain level. This should be included in every trade. This should be included in every trade. Yep. Aim for trades with a risk to reward ratio at least 1. Aim for trades with a reward to risk ratio of at least 1. Studies have shown that traders who enter trades with a reward to risk ratio of 1 or higher tend to be more profitable. The ratio refers to the potential profits and losses bar for trades. By only taking trades with a ratio higher than 1, you need fewer winning trades to break even. Need fewer winning trades to break even. Calculate your position sizes correctly. Many traders struggle with calculating position size to maintain their defined risk per trade. Position sizes are crucial in money management as they determine a trader's potential profits. To calculate position size accurately, take the total risk per position and divide it by the risk per trade. This result gives you the maximum value you can take to maintain your defined risk per trade. For example, if your total risk is 1% of a £100,000 account, your risk per trade is £100. If you trade with a 10 pip stop loss, let's say you're buying GBP/USD at 1.2 with a stop loss at 1.19, your position size, how much you can buy or sell, is then £10 per pip. 1.2 minus 1.199, 1.2 minus 1.199, 10 pip per risk multiplied by £10 per pip spread equals £100 risk per trade. If your stop loss is at 1.19, you'd be risking 100 pips and your position size will drop to £1 per pip. I think we already got a formula for calculating a position size from the babypips.com. So yeah, that's good. Position sizes determine a trade's potential profit. Okay. Be cautious with leverage. Trading with leverage can attract new traders to financial markets. However, leverage is a double-edged sword. It can increase profits, but it can also magnify losses. Be cautious, understand the risks when trading with leverage. Yep, can increase profits, but also magnify losses. Just don't use it as a new trader, or use a very low one. Avoid greed. Greed and fear can harm your trading decisions. With experience, you'll learn to manage your emotions so they don't affect your trading. It's important to be realistic about your goals. Avoid overtrading and set unrealistic high profit targets. A trade with a high risk and low profit target is likely to result in a loss. Avoid overtrading and setting unrealistic goal profit targets. A trade with a high risk and low profit target is likely to result in a loss. Use trailing stops to secure profits. An effective trading money management plan should include different types of stop loss orders for different market conditions. When a market is trending strongly, it might be wise to use a trailing stop to set an average height of the correction wave. Set at the average height of the correction wave. Your trading plan should include different types of stop losses for different market conditions. When a market is trending strongly, it might be wise to use a trailing stop set at the average height of the correction wave. This allows you to secure profits as the trend continues, as the trailing stop automatically adjusts your stop loss. Remember, successful trading requires discipline, patience, and a solid money. Remember, successful trading requires discipline, patience, and a solid money management plan, which is your trading plan, basically. Okay, very good. So that's done. What is Forex and how does it work? So in the next video we can then move on to the online trading courses which IG offers. I'm going to leave this episode here then. Thank you for watching, and I will see you guys in the next video with online trading courses offered by IG. Peace.